Good evening, ladies and gentlemen. You're tuned into India Tonight on ET Now with me, Sumita Karir, and my colleague Jude Sanith is joining in from our Chennai studios. Jude, we have lots to talk about on the show today. What Ananta Nageshwaran essentially said, the BJP's new organizational team, and of course, what's happening with the rupee. So let's first, in fact, focus on that. The rupee was under pressure today after the RBI shortened its NRI FX-swap window by a month. In fact, the currency slipped to 95 rupees and 60 paise per dollar, while importer demand and higher oil prices they added to the pressure. RBI intervention is cushioning the fall, we're given to understand. In fact, my colleague Meryl D'Souza is here to explain more on this and put the story into context. Meryl, what is it that we have seen and what is going to be the likely impact of this move?
Right, so the rupee is back under pressure, weakening about 0.2% to 95 rupees and 60 paise against the dollar, hitting a 2-week low. The trigger is that the RBI has shortened the NRI FX-swap by about 1 month, a move that has surprised the markets. Remember, the scheme had already attracted more than $50 billion, and Bank of America estimates that total inflows could potentially reach around $80 billion. So any curtailment now raises concerns over future dollar inflows and rupee support as well. This comes despite earlier RBI commentary suggesting that there was no immediate plan to shorten the window, and at the same time, importer dollar demand is also adding to that pressure. While the RBI is likely to cushion the fall through intervention, including dollar sales via state-run backs. The pressure is also visible in the forward market. 1-year USD INR forward premium has now risen by 8 basis points, reaching up to 2.79%. The big risk now to watch remains crude oil. Brent is hovering near that $88 per barrel range, and higher oil prices could now widen India's import bill and put further pressure on the rupees thereby. The silver lining, however, is that the dollar index is softer at around $99.4, while stronger Asian currencies are providing some support as well. So for the rupee right now, it's a tug of war between RBI intervention and external pressures, with crude and dollar inflows both remaining key variables to watch ahead.
Well, thanks, Meryl, for that perspective. Lots happening then with the rupee, even as it is engaged in a tug of war there. But to help us put this in a bit more perspective is our very special panel of guests. We have with us this evening Abhizir Diwanji, the founder at Neostrat Advisors LLP, even as Ashwin Parekh, managing partner at Ashwin Parekh Advisory Services, joins us on the show. Abhizir, let me start with you. Now, the RBI, help me understand this, has attracted more than $50 billion through this NRI forex swap program, and yet the rupee is around 95.6 to the dollar. Now, why isn't that huge dollar inflow supporting this currency more strongly?
So first of all, the dollar inflow is still coming in. Okay? And you will find that as the swap window nears its closure, more and more of these dollars will come in. I think today's implication was simply because of the abruptness with which Reserve Bank of India shortened this window. A lot of people who were expecting this window to go on till 30th September are not going to see that now. And hence people thought that, oh, the dollars will be less. But do believe that when the credit policy was announced, industry estimates were around $40 billion. And now we are looking at close to $60 billion. So I think the dollar reserve flow will come in. This is just a market reaction to the fact that it was abruptly lowered down in a day, though giving an assurance a week earlier that it will not happen. So I think this is just a market reaction, in a way a knee-jerk one. But the reality is that we will get huge amount of dollars coming in. And by the way, by far, whether you look at the Resurgent India bonds of 1998 or the 2003 2000 IMD issue, or the one in 2018 that Raghuram Rajan did, in all of that, we have not received this kind of money. And this is simply because, the RBI has effectively subsidized the swap cost. And it has opened up the ceiling for FCNR rates. So that's enabled people to play on the gap, really.
Right. So, in fact, let me also get in a word from Mr. Ashwin Parekh. Ashwin, what do you think is behind the RBI's decision of closing this a month earlier, given the fact that we were getting a rather good response with respect to this particular scheme?
Well, I mean, I've analyzed that there could be 4 possible reasons, One is, of course, when in June, I mean, the RBI announced the swap scheme, NRI swap scheme. The original target was just about $70 billion. Then we started getting good response. And this time around, like in 2013, the main factor for the response was the leveraging of the deposits, basically. So we saw that different banks were leveraging allowing the NRIs to leverage their deposits. It ranged between 9 to about 15 times in case of some of the foreign banks. That has really attracted the attention of the NRIs, and that's the reason why we saw good flow. What is, however, a little intriguing, of course, is that we were getting mixed signals. When we had already mobilized about $40 billion, by way of FCNRB and also the OFSB as well as the ECB, other, let's say, instruments through which, let's say, the dollars come in. Then we got an indication that there was no question about, curtailing shorter the period of this particular scheme. Suddenly today, we get this announcement. Yesterday, RBI made this announcement. Today, we get this, that the window is going to be closed on 30th. So 3 or 4 factors. One is we've already got, as we speak, RBI's latest announcement is $56.3 billion by way of FCNRB deposits. That's one major reason. Second is, if you see, I suppose the Fed perhaps has played a larger role. The scheme was announced in June. Fed, July, the stance, under the new governor at Fed, the stance has changed. There is suddenly a hawkish stand, and there is question about hiking the rates now. So we are talking about even a stronger dollar. We are talking about RBI's risk, associated, and therefore the amount of the burden it will have to carry to repay that amount between 3 and 5 years will only keep on rising if the the rupee doesn't hold. So these are these factors. And perhaps the last one, compared to the Indian banking companies, I suppose the foreign banks this time have been able to raise, far more deposits. They've not only leveraged the complete subsidization of swap cost, but also at the same time, they've used their own balance sheets basically for the dollar deposits. So I suppose these are some of the factors which have played their part. But personally, I do believe that if the original target was $70 billion, and if we already mobilize around 60 by way of all the 3 schemes put together, then I suppose we are there. We are almost there. Before 31st of August, a lot of dollars. As Abhiza said, we will certainly be expecting a lot of dollars to flow in, basically.
Absolutely, that expectation, of course, is all set right there. But Abhizir, if I could bring you back into the conversation, help me try to understand and analyze what the RBI could well be trying to do here. For instance, is the central bank trying to defend a particular rupee level, or is it simply trying to prevent a disorderly fall of sorts? And if yes, how long can it keep doing that realistically?
So first of all, we got to understand that what the RBI is trying to do is arm itself with dollars where it may need to support the rupee at some stage. And as Ashwin also said, that we've got what we had to get, and we kind of should be stable at that number. The problem really is, as again Ashwin said, the exchequer will want to control their costs, because the cost this time for the hedge is on the exchequer. If the US market becomes hawkish and the dollar goes higher, then very frankly, the government's burden will go up significantly. The government will have to decide that this is the level of dollar I'm willing to take to be able to meet a future burden. That's on one side. The other side is to understand in India's side, the dollar outflows are governed by a higher oil price and the tensions happening in the Middle East, which is pretty much out of our control. The other big thing is that taking the advantage of stabilizing of the dollar in the current situation, our foreign institutional investors have been constantly selling in the markets. So clearly, you look at the situation where there is capital outflow because of the foreign exchange. There is increased oil outflow because of the Gulf War. On the other hand, the US has an hawkish stand, which basically widens our spread significantly for the RBI to take the risk. So at some stage, they would have had to decide that, well, this is not a free flow, then let me get all the dollars I can. I will have to manage my risk at a particular dollar level. And RBI would have said that this composite level should be at around $60 billion.
Right. So, in fact, Mr. Parekh, let me also get in your thoughts on this. Now, with this facility that the RBI created, of course, there is liquidity in the system. But could we look in the future, in the near future, at liquidity management of all the liquidity that's been created in the system, and how would the RBI move on that?
Yeah. So, see, as far as the domestic current liquidity is concerned, in the last policy also, the governor has very clearly indicated that the liquidity at about 1 lakh crore plus in the system at the moment sort of should take care of, any amount of liquidity sort of upside or downside. But and then of course, the OMO and other windows are available to the RBI as far as the domestic liquidity is concerned. Now, as far as the dollars are concerned, already we've seen several measures have been taken by the RBI. We know now that, for example, the open positions of the banking system are not a function of the percentage of their net worth any longer. Only $100 million a day sort of is the open position that's normally allowed for any particular banking company. So there is a lot of issues around dollar flow and which is already being managed by the RBI. To my mind, RBI is not supporting a level. RBI is, I think, looking at the volatility in the rupee. It's only addressing that. I think at some stage or the other, both the government and the RBI will have to let rupee reach a point of, without any too much of intervention, when the market forces a certain level that it has to find on its own, basically.
Now, Abhizir, coming back to you, if in a situation where oil stays elevated while the rupee remains weak, how much should we be worried about fresh inflationary pressure building up in India, and how soon in terms of a timeline could that become a very real risk of actually happening?
But very frankly, inflationary pressures are there in India because of oil, because oil is associated with almost every cost that this country incurs. Everything involved. First of all, oil is going in your airlines, it's going in your transportation, it's going in daily usage of our people. So at the end of the day, I think oil-related inflation is a very big component of our markets. The other thing is that because of that, ancillary costs and because of the war in general, ancillary costs are also pushing up inflation. So India forever has had a supply side inflation to a great extent, and that supply side inflation is triggered most by oil. So clearly, we are trying to find fisc as an answer to operations related inflation, and that's always a challenge to deal with. Very frankly, I would commend the RBI for trying to balance its books the way it is. But frankly, we don't have too much choice.
Absolutely, Mr. Abhizir, very rightly put. The kind of balance that the RBI has struck is really commendable. We have time for one final question, Mr. Parekh, and let me come to you. We were speaking about how there is volatility on account of oil prices, and of course, this creates a fine balance. But what are the rupee levels that you're working with over the next couple of months? Because the Middle East crisis is not really over yet. There is no sort of a deal that's been struck, or at least has been arrived at between both the sides. So what are the rupee levels that you're working with? Because oil prices, they predictably will keep fluctuating and moving up and down.
Yeah, so it's anybody's guess, quite honestly. The kind of level that rupee will find, a lot of narratives are actually coming out of the Iran and US kind of situation at the moment. On every second day, we find that things are going to calm down, and then once again things flare up. So, and then once again it has its impact on the oil price. I think the only redeeming factor, if one was to really look at it more seriously, I think is the food inflation. We seem to be now getting to a point where, as Abhizir said, oil is going to be the major concern. We talked about, below normal kind of monsoon this year, but fortunately, from the numbers that have come out so far, it looks like a larger area of, the cultivable sort of land in India seems to be receiving at least 90% of the normal kind of rainfall. And therefore, the food inflation could ease, a little bit by November, December. So I suppose that could be one of the things that RBI also must be keeping in mind. Food inflation is not going to be as much of a let's say, challenge as we go along if the monsoons were to continue the way they are. So oil, and therefore the Middle East sort of, tensions is the only concern rupee to find a level, basically.
Right. So it's a day of reckoning then for both the rupee and India's central bank. So on that note, Ashwin, Abhizer, thank you so much for joining us on the bulletin and discussing this tonight. Great speaking to you both as always. Thanks a lot for joining us.